markets at the moment, as we have been saying, yet to make up its mind whether the foot should be on the accelerator or on the brake. To understand where they are headed, Anand Tandon of JRG Securities is with us. Anand, thank you very much indeed for joining us on what is likely to be a very big day as far as both macroeconomics and markets are concerned. What's your sense? Do you think we are really dancing at the moment to global cues that the incipient US recovery is taking away attention from the already recovered emerging markets, and this theme is likely to dominate the first quarter of 2011?
Well, Lata, the obvious answer is that the US markets are looking a little more attractive because many of the companies are showing some kind of growth there, whereas the valuations are far lower than what those growths are likely to entail, whereas in most emerging markets, including India, the valuations are way out of whack with whatever the numbers the companies can report. And in a scenario where you expect that inflation and interest rates hopefully will continue to remain firm, the interest rate remaining firm is what I meant. You are not looking at a scenario which is necessarily very good for risky assets. So on a relative basis, I think funds will flow back into the US market, and therefore you can't be relying on international fund flows for the equity market to move up from here.
Well, on the other hand, domestic flows have not really helped. We have not seen the mutual fund kitty really bulging at all. Domestic investors have been still a little shy of coming to the stock markets in whichever way. So, therefore, you would say that we are really not going to get much steam beyond 6,000, or not really see any sizable gains in the coming year, at least the early part?
I think so entirely, Lata, especially if the government continues to have a disinvestment program which is very aggressive. My personal view is that it will actually taper off because the market won't be that supportive, but in case they do try and sell a lot, then you may actually find some downside. The only silver lining is that the last 3 months of the year are the months where the insurance premium actually get collected, and usually the insurance companies have a reasonable spike in terms of their ability to invest. If that were to be sustained this year as well, you'll probably find that at least the markets can sustain in the current levels. Otherwise, they are somewhat heavy.
So if your aim is at least capital protection, then where do you hide in this ensuing, say, couple of months or a quarter or longer?
Well, it depends on your time frame and risk profile. But for example, the fact that interest rates have started to harden now gives you some opportunity to get out of riskier assets and put money into debt. There are FMPs which are now giving you close to 9%, at least for the near term, the next 3 months or so. So that's an attractive opportunity, I think, especially when you look at the fact that the alternate is putting money into equities, which is yielding you about 5%, and where the growth, to my mind, is though it's likely to be let's say 15 to 20% next year, it's unlikely to be significantly more than that. And in fact, currently the consensus seems to indicate that it will be higher than that. I'm suspecting that the consensus will move down for the next year as well. So with a 5% yield on that and 8-9% on debt, for the near term at least, the markets are not that attractive.
Okay, I was referring to actually some sectors within the market itself. If one is staring at FII portfolios not really flooding in the first quarter, and crude prices remaining where they are, probably because of quantitative easing even edging higher, then are you looking at probably more weakness in the rupee? Would IT be a sector you would dip in, or just not take profit?
So I think on a relative basis, IT would be attractive because I think the rupee may actually weaken a bit, and also the fact that there is somewhat of a resurgence in growth in the US will mean that demand should perhaps become better than what it has been in the recent past. So on both counts, IT would be something that you may want to take as part of your portfolio. Can you be significantly overweight? I think not, because again, most of the frontline IT companies at least are more than fully priced. However, there are changes in IT, so there will always be, see, the attraction about the Indian market is that we have so many companies that, when you start looking at a company-specific kind of story, you can always find something that looks very attractive. But if you look at it top-down and say, look, I need to put in some serious amount of capital to play there, then, you have to get back to the top 25, 30 names, because that's where all the volume is and that's where the liquidity is. And none of those stocks that I can see offer you a huge opportunity to do anything other than perhaps trade in the near term.
Okay. Well, I don't know if you would take a stock-specific answer, but you have referred to be stock-specific in your selection. What about Hero Honda after the recent events and the walking out or the breaking of the JV? Do you think it's fallen sufficiently enough to reflect the concerns? Does it become a buy at this juncture?
That takes a bit of time for a company like Hero to actually have, rebuild its portfolio, especially its R&D thing. If you remember what happened with Bajaj, it took them several years before they were able to set up an R&D program which actually started to deliver, and of course we have seen the results of that after that. But for any company which has not had that culture of developing its own products, it will take a few years for it to develop that product profile. And in the interim, you're looking at a situation where perhaps they will have to be paying royalty, and the royalty may become more substantial than what is being paid currently. Depending on how much the royalty comes out at, you'll find that the EPS figures are fairly sensitive to that. You're looking at, it could all as much as half if the percentages are steep. I mean, otherwise it could be so it depends on where the royalty figure comes out to be, and till that is not clear, you are really shooting in the dark. On a purely technical basis, the fact that it's a huge company with a very strong distribution and a very strong customer loyalty obviously means that at some stage it will become attractive. I think the stage is not yet perhaps just been reached right now.
All right. Anand, minutes away from the credit policy, how is the stock market receiving or entering this event?
I think it's very low expectations. I think by and large the consensus seems to be that nothing will change. And if there was therefore any change, especially in terms of tightening of any kind, the market will react a bit negatively. But I think to some extent, the RBI governor's maneuverability is somewhat limited right now.
Fair point.